Focus on metals, and that really has been a very lackluster sector all of 2018 after the massive rally that played out in 2017. So what are the dynamics? Is there more pain? Can this downside be capped? Can this downside be bought? Pankaj, what's the opinion that you're gathering on metals?
Let's look at some data first, Aisha, and talk about what's happening in the metal space. So this is just the prices this week so far, which is just a couple of days into the session so far. So LME copper is down close to about 3% odd. You have copper is down 5%, aluminium is down 3%, zinc is down 6%. Some of the other metals have also declined. However, they are not so well traded, but there have been significant cracks as well. Nickel and lead have been slightly flat. The positive bias, you can say, of 0.4, 0.3% is not quite high into these names, but overall there is a crack in the metal. Now you come down and look at the Indian stocks and how they have done. In terms of Nifty Metal Index, on a YTD basis is down close to about 14%, but it's coming in after a rally of close to 100% in the last 2 years. So that's the sort of rally that you've seen, after which you've seen a 14% decline. And it's not only about the mid-cap names, even the large ones have really started to fall. So you have a name like Tata Steel, which is down close to 20%. You have a name like Vedanta, which is down close to 30%. Hindalco is down close to about 18.5 to about 19 odd percent, and Nalco, Hindustan Copper are also some of the other ones. Even some of the other ones, the large ones that we keep speaking about, have not really performed in this particular 14% sort of a down move. Now, there are a lot of factors. Firstly, the demand supply situation is not that bad, but what's happening around the world is that the trade war that US is threatening is leading to some demand changes or demand coming out from other world. Returning of a cult to EM is one of the biggest fears. Basically, dollar index moving and that in turn having an impact. China is the biggest consumer of most of the commodities around the world, and China macros may have weakened in the recent data suggest, and that's the reason why it is happening. And for the last 2 years, when we told you about the 100% gains, even the profitability of some of these companies were quite significant. So they have gone ahead, increased capacity, tried to find more, and that's why certain metals like zinc have seen inventory going up about 80% in the last few months. So the prices were doing well because demand was higher than supply, and now supply or stocks have also started to come in because companies made profit and they started to invest them to get more amount of these metals, and all of these are playing an impact on the metal stocks.
All right, Pankaj, many thanks for that. Metals remain lackluster in 2018 after their massive rally in 2017. And mind you, 2016 as well. It's a multi-year bull market that metals have enjoyed. So are we at a point where things could reverse? Because when things get bad, historically, we know, Rakesh, that they can get really bad for the commodity markets. In fact, like I said, Rakesh Arora, MD Go India Advisors, joins in with his perspective. And Rakesh, that's my point. Sometime in the cycle, you would be thinking, okay, the downtrend has begun.
Yeah, I mean, see, that we have been warning for some time. Because last year, China, they had a crucial election and they primed the economy. So a lot of demand was front-ended from the infrastructure projects that they were trying to do. And the demand after the Chinese New Year hasn't really come through. And so that was one of the major, fundamental hiccup that we saw. And now, as, Pankaj pointed out, the trade war and the rising US dollar, both are becoming a drag on, the commodity trade altogether. But having said all this, the mining companies have not been able to keep pace with capex. The demand went up in the last, 2-3 years strongly, whereas the capex in mining sector hasn't happened. And that is somehow holding back these, commodity prices from collapsing. So the stocks have corrected quite a bit, and there is a little bit of, potential rebound possible, especially, in the steel sector where steel prices have been going up, whereas raw material prices haven't really moved up much. So steel companies will be showing a sharp margin improvement. Even the last quarter was very good from margin improvement point of view. And I think Q1 is also going to be, even stronger. So to that extent, people looking to play short-term trade can look to, maybe invest into steel companies. They look better placed as compared to the base metals.
What do you do? As an investor, what is the right approach? Do you buy this decline? Do you wait out for lower levels? And if you do buy into this decline, what is it that you buy?
From an Indian point of view, most of the steel companies, the only large steel companies are left now in fray, and there are only two major options, Tata Steel or JSW. Now, my preference would be to stick to somebody which is integrated like Tata Steel, And the reason I would say is that there is potential possibility of disruption of iron ore mining in India. We're expecting a few judgments in July, August. So that could play negative, sentiment on non-integrated companies like JSW. So Tata Steel would be slightly better off in that kind of scenario, but both the companies will show very strong results in Q1. So as I said, short-term play, 1 month before the results, probably this is the time.
Rakesh, one side is demand, second side of the equation always is the inventory level. What is your understanding on the inventory level? Because they also will have a very large role to play the way how prices would move in the short term.
I mean, if you're talking globally, then see, inventories haven't really moved up much, but that is the new normal in this world. I mean, the inventory levels used to be extremely high before the global financial crisis, and after that they have all been declining. So inventories are not that high. And as I said, the capex into metal mining sector has been pretty weak. So both these things augur really well in terms of supporting commodity prices from a deep, correction. So, but that's about it.
Yes, our understanding of the Chinese market is that suddenly some degree of price discipline also has kicked in, which is that Chinese government is committed that companies or businesses which are not making money get out of them. So it's no longer that China was dumping and China was in a sense, breaking the prices down. Will that have a very large role to play, that when pricing discipline comes back, the downturns in commodity prices would be limited and restricted? Yes, we may be off from the recent highs, but ultimately this is a good time to buy into commodity stocks rather than running away from the decline.
Yes, so as I said, if we are not expecting a deep correction in commodity prices, and stocks have already corrected quite a bit, as Pankaj was enumerating. So probably the downside from here looks less as compared to a potential upside. So for short term, yes, one can trade. But coming to your point on China, see, China has been cracking down on pollution, and it was more than what anybody expected that they will do. But see, remember, China, when it closes down some inefficient, polluting plant, it builds a much better plant. So, for example, in steel, they have renewed their focus on, steel making through scrap. And they have huge, amount of scrap which has been accumulated. So, a new wave of supply is definitely going to come on the steel side also. So it's difficult to take a long-term call right now on these commodity stocks, but I would say short-term, there's a little bit of a trade out there.
Okay, Rakesh, appreciate your time and thank you for joining us. Markets meanwhile, well, yesterday global markets recovered after that triple-day decline what Dow had registered on Monday. Which means that the bulls were able to make a comeback. But the recovery in global markets is not strong enough, which may look very heartening for the bulls. So for the moment, I guess benchmark indices are in this nowhere, no man's land. We're not going here, we're not going there, we're getting stretched, I guess, in no single direction. The market breadth is better than what we've seen yesterday, but again the market breadth has been very, very fickle. Friday was good, Monday was bad, Thursday was bad, and Wednesday was good. So the market breadth again is no indicator of what is happening to the mood of the market. The approach has been subdued. Mid-cap stocks are correcting, and the next management whom I want to interact with, and before I go to the management of NBCC, I just want to mark what's happening to the stock. And here also, in line with what's happening to other mid-cap stocks, NBCC stock has seen a decline of nearly 30% from the recent high.